It's no secret that SoFi stock has not had the best year so far. The stock is down 24% year to date, and at the time of making this video, the stock is down 4.18%. Why is that? Well, CPI report came in a bit hotter than expected. And SoFi, the stock right now, is a stock that is quite, let's say, linked to high interest rates. The higher the interest rates, the longer the interest rates stay high, the worse it is for SoFi stock. But is it actually true? Is that actually the case? Because last year interest rates were high as well, inflation was high as well, and SoFi's business was doing quite well. SoFi's guidance last year was pretty conservative, and yet they beat and raise. This year, SoFi's guidance also conservative. Although they are expecting 4 rate cuts, right now the market is expecting 3 rate cuts tops. Still conservative, as you will see in just a second. If we look at the FedWatch tool, you can see that right now, for the July meeting, there is a 55.9% chance that rates will remain unchanged. If we go and look at September, in September, there is now a higher probability that rates will get cut, only in September. The same story goes here in November and in December as well. In December, the highest probability of experiencing already some rate cuts beforehand. But there is still 12.4% chance that there are no rate cuts this year, and this has increased quite a lot since last month. Last month, the chance was 0.1%, last week 1.3%, yesterday or 2 days ago at the time of you watching this video 2.1%, so quite a huge increase. Now if we look at the 6-month treasury and actually the 3-month treasury as well, we can see that since the start of 2024 the yield has gone up, which means expectations are quite low to see a lot of rate cuts, to see more than 3 or 4 rate cuts this year. If you zoom out, of course, in a low interest rates environment, that was much lower. But yeah, last year, 2023, it peaked and then it went all the way back down as the expectations of plenty of rate cuts in 2024 were quite high. It went down, and then since the expectations became, well, unrealistic, that has gone up, and this is also a quite good indicator as to what might happen throughout the year. Now, SoFi itself, again, like I said, look at the business, less the stock. The more time the stock trades at around $7, $8 or maybe less, the better it can be for you. The more shares you can accumulate, which means the higher the return will be in the future. Don't be scared to maybe have a higher average. At the end of the day, if you have more shares, that's the end goal, right? Unless you want to trade, then fine. Okay, then I can understand. But at the end of the day, you want to have as many shares as possible for a reasonable price. Now, I do want to share this post by Chris Patel on X. Great follow if you're not following him. This may be counterintuitive, but the Fed needs to start cutting rates sooner rather than later. Shelter, which is one of the largest contributors of inflation this time around, is inventory locked because of high rates. People with below 4% mortgages are not likely to list their homes, especially if they have to take on a 7.5% mortgage for their next home. This lack of inventory is causing a supply and demand imbalance, where existing inventory is getting bid up and thus causing inflation. We need a two-pronged approach to get more inventory to the market while at the same time putting up guardrails to keep Wall Street and private investors from coming in and buying up all the excess inventory. 100% agree on that point. And I said here, build, baby, build. Just like you have to drill, baby, drill to keep the gas prices down. Here, with regards to housing, rent, shelter, you have to build, baby, build. But of course, in a high interest rate environment, most people will not build, baby, build because it is extremely expensive. So you're like in this endless cycle of things not moving in the right direction. So yes, at some point, a decision needs to be made in order to continue. Because yeah, if you want housing prices to come down, if there is too much demand, then you have to increase supply. At the same time, you have to make sure that the supply goes to the right people and not to the hedge funds, the private investment people, etc., etc. Because then they can just price it at whatever they want. This is not the goal you want to reach. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. We're on our way to reach 40,000 subscribers, so please help me reach that number before my 30th birthday. Really appreciate that. Want to support me even further? To check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So going back to SoFi, right? Like I said, last year, guidance at the start of the year, pretty conservative, pretty, let's say, dark grayish view on the economy, and yet they beat and they raised. Was a pretty good year for the SoFi business. This year, same story. So if we go back to the earnings call, so they assume a contraction in GDP in 2024, an increase in unemployment to higher than 5%, which is far from where we are today, and broadly a continuation of uncertain capital markets activity and continued normalization of consumer credit. From an interest rates perspective, we are assuming 4 rate cuts in response to a contracting economy, higher unemployment, and deteriorating and normalization of credit performance, with Fed funds rate reaching approximately 4.5% by Q4 2024. Now let's look at a scenario where we only get 3 rate cuts, but there is GDP growth and unemployment is below 5%. I think SoFi's business will still be doing quite well, despite not having 4 rate cuts, but only 3. Even if it's only 2, if unemployment is still below that 5%, which I fully expect it to be unless something drastically changes, if there is some GDP growth, I mean, SoFi as a business will do well. SoFi as a stock, probably the market or these types of stocks are waiting for that rate cut in order to suddenly increase. Although I still think that we're going to see an increase, the usual increase after a beat and a raise for the next earnings report. It's just my prediction. And then the stock will fall off like it has done for the last, 4, 5, 6 quarters or so. But looking back at their conservative outlook of this year, I mean conservative, it's a pretty darkish outlook, which of course allows them to navigate this year in their own terms, right? Unemployment is now at 3.7% or so, so quite far from the 5%. The economy is still doing quite okay, so GDP-wise, we're fine there. The only issue here is going to be the rate cuts. But that's the least of our issues from a business perspective, because I do think that if there is a contraction in GDP and if unemployment is higher than 5%, then we are in deep trouble. And it's just not only for SoFi, but for plenty of other businesses out there as well. And remember, even with their conservative view of the lending business, they still expect 50% growth in revenue of tech platform and financial services combined, and to add at least 2.3 million new members in 2024, which represents 30% growth. So yeah, in my opinion, I think we have to look at the business and less at the stock, plus all the headlines talking about inflation and stuff like that. Remember, stock market is near its all-time highs, despite super high inflation and high interest rates. So yeah, good companies don't really care about the headlines. Then last 2 things here. One, some positivity for this video. So Citi resumes SoFi coverage at buy after model update, financing actions. So Citi resumed coverage of SoFi Technologies with a buy high risk rating as Analyst Ashwin takes into account the lender's recent financing actions that are expected to save it $40 to $60 million in annual interest expense and dividend payments. SoFi exchanged $600 million of its 0% convertible senior notes due 2026 for around 73 million shares, which should benefit its total risk-based capital ratio and add to Q1 GAAP income. Also, it issued 1.25% convertible senior notes due 2029 and enter into capped call transactions. We've talked about that in the past. Our fundamental bullish view on SoFi remains unchanged, especially as its intended business diversification comes into focus. Its ability to continue to attract deposits continues to prove itself out, and investors focus on forward profitability. We've also increased our net interest margin expectations for the next 2 years as we anticipate the company will continue to replace higher cost funding with lower cost deposits. Then we've got an upgrade at KBW, so they went from underperform to market perform last Friday as the stock's recent slump combined with the fintech bank's $750 million debt offering remove much of the risk of negative catalyst to investors over the near term. I believe they were also the one that downgraded SoFi because SoFi was suddenly at $10 and they thought it went up too fast. So yeah, focusing on the stock price and less on the business is not really my thing here. But okay, I guess we'll take what we can get. So overall, yes, the headlines say it's bad, less rate cuts, stock market is down, etc., etc. I say buying opportunity of great businesses. Some businesses will still do well in a high interest rates environment, some won't, but we will not stay in a super high interest rate environment for years and years to come. So if you're a long-term investor, take the opportunity to add to your position. That's all I have to say. Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.